Hey, Sarah, good morning. I am here with Brian Moynihan, the chairman and CEO of Bank of America. Brian, thank you very much for being here from your financial services conference. Rates in focus this morning. Chair Powell is on the Hill. We got the CPI number this morning. How does that change your assessment of where rates go from here and what that means for everything from loan demand to investment banking activity?
Sure. So let's talk about a couple different things. One is our research team, Candace Browning-Platt, and this very strong research team was the reason why we're here. They'd taken all rate cuts off the table in their research. The market had one still left in. They had zero. And it was because they thought that the dynamics of the inflationary effect and the potential inflationary effect would cause the Fed to hold back. And those rates are restrictive, but there was not enough sort of inflation progress going to be made, and inflation was going to stay in the high twos through 25 and 26, and ultimately they would start cutting rates then and bring it to maybe 3.5, 4. So that was their basic. The other thing is, if you look at the consumer activity, as you came through the fall, summer and the fall, it had slowed down. It kicked back up once the Fed started cutting rates, and now for the first 40 days of the year, our consumers are sending about 6% more money into the economy than they did last year for the first 40 days. And so if you think about that, that's a little faster than it was for the fourth quarter, sort of 4.5, 5, 6, which the money's moving, which means the enthusiasm for everything going on in the stock market being up and people taking trips and stuff, that's going out in the economy. And so I think that's helped drive, that's driving price firmness, demand firmness. That's a lot of money. It's a $4 trillion a year goes through our customer accounts. So you're seeing that activity. That says that we're probably in a period where rates are going to stay kind of where they are for a while until this settles in.
It's one of the big reasons why everyone's been so excited about bank stocks, and we're here, of course, at the Financial Services Conference. As your analyst put it, rates was a key component, rates regulation and resumption of client activity. Does this kind of pour cold water on the whole bank's thesis and the upside on bank stocks?
Yeah, remember the projections we gave at our earnings call a few weeks ago was to be up 6 to 7% in net interest income, 25 versus 24. That had one rate cut in it because that's what the market was. So the idea of one less rate cut will actually, when you have a bunch of zero interest accounts, they make a little bit more money. The question is, what's the constraint on activity? And if you look across the activity level, the consumer spending, we had good loan demand when rates were where they were in the fourth quarter. Year-over-year loans were 3% up. Commercial loans, ex the CRE business, which, commercial real estate, which has been going down, was up 6 or 7% year-over-year. Consumers up 1%, but you saw areas were stronger. So we saw good loan growth, and that's good. And so the amount of activity, the profit margins are strong. It can withstand this higher rate. It has. The question is, how long can it withstand it? And that's going to be down to some of the policies and tariffs and all this stuff and how people assess them. The real impact of rates, though, is in small, medium-sized borrowers because they borrow on lines of credit. And so their basis was 50 basis points SOFR back then. Now, 4%, that's 350 basis points more they're paying for a line usage. And so their line usage is still muted. And so until those rates come down, there'll be less enthusiasm there. The mortgage market's obviously slow. Car buying will bounce around because the rate structure passes through there. So the impact on the economy is much more complex by types of customers. But everything we see, and for banks, was the activity consistent with a Fed funds rate where it is going on. And so that will happen. On the market side, spreads are tight. The capital markets are open. The IPO market really is a question, and will people feel confident enough a valuation drive through? IPOs are up a lot more than the general market last year. Year to date, they're up a lot more. But the question is, that's driven by a narrow set of IPOs versus a broad base. And we expect that to come. The pipelines are full, and I think that's a stability question. It's not going to be sensitive to 25 basis points or not on Fed funds rate. It's really not.
And that speaks to your earlier point about just corporate confidence. And a few weeks ago in Davos, you asked President Trump what his executive orders meant for growth. He said they would be great for growth. I'm curious if you're hearing the same thing from clients, because there's been a lot of reporting when I talk to sources as well that a lot of the uncertainty has kind of created a chilling effect, and that a lot of C-suite executives want to pause and see how everything filters out before engaging in big transactions.
I'd say especially for multinational companies, because for every reaction is an equal opposite reaction, and they're trying to figure that out because, if you're bringing materials in and they come with tariffs, and how do you pass that through? So that's going to cause it. Now, we're 39 days in here or something, whatever the math is for the new administration. So they're putting a lot of things out there, trying to hit the ground running. So I think it'll just take a little while. But in the grand scheme of, 4 years in the grand scheme of these companies, it's a little uncertainty until they see the settlement. It is causing people to say, wait a second, how will this affect me, especially people who deal across borders and stuff like that. For the local U.S. economy, the deregulation's high hope. Interest rates being higher, it has been a countervail. The ability to get employees is now surfaced by our customer data. That question is probably nothing really happening, but their fear that they may lose employees to employee capacity to immigration policy and not be able to make it up by efficiencies fast enough. So businesses are paid to worry about the future. That's what the CEOs of all size businesses, it's their, even the entrepreneurs, it's their money. They're worried about it. So they'll worry about this. But I think as you see the things move from the thoughts of policy to actual policy, that stability would be very helpful. And I think lessons learned is you make a lot of change fast, people stand back. It's okay as long as you follow through and get stability, and we'll see what happens.
And speaking of Davos, you participated in a roundtable. You were able to ask that question to President Trump. And then at the end of his answer, he told you that, quote, I hope you start opening your bank to conservatives, adding, quote, what you're doing is wrong. What was going through your mind at that moment?
Well, what was going through my mind is we bank 70 million American consumers, so our bank is open to everybody. And so the question he was really after is overregulation, and it's around this question of BSA, ML, and at the end of the day, we have rules that haven't been changed in 50 plus years. So the currency transaction report level in the United States is $10,000. When it was put in, somebody said to Congress the other day, you could buy a fully loaded Cadillac for $10,000. I think now you can't buy a new car of any sort for $10,000. So we haven't indexed these things, so it's causing a lot of activity, and the overregulation of that, and the inch wide, mildly pull our industries in by compliance with that. The regulators would come in, there's no upside. So what happened is if you go back to Caribbean countries, which have been a talk of years of debanking Caribbean countries, it was because we had to know their customer's customer. If it came back to other activities, we're responsible not only for our customer, but for what goes on in their business, which is different in most industries. So this idea of getting this regulation straight, we're fully in favor of, and we're trying to help do that. And so the question was, he was talking about debanking and regulation, and if you heard the rest of the response, it was, look, the last administration, we agree with it. We have to get this back in balance.
Have you spoken with him since then? Because you didn't respond in the moment. I'm curious if you've spoken with the president since Davos.
I have not spoken to him. I've spoken to parts of the administration. We continue in Congress to continue private input for the industry. This is an industry-wide problem that we've got to fix.
All right. Well, Brian Moynihan, really appreciate your time today. Thank you very much for joining us from your financial services conference.
Well, thank you for being here, and hopefully the team's treating you well.
Appreciate it. I'll send it back to you guys.